CoreWeave is a specialized AI cloud provider that recently listed on Nasdaq under the ticker CRWV, positioning itself as a key infrastructure player in the AI economy. The theme of this presentation is AI infrastructure hypergrowth and challenges. On the one hand, the company is scaling extremely quickly as demand for GPU-accelerated compute soars. On the other, that growth comes with significant financial and execution risk. Over the next few slides, we'll cover CoreWeave's business model, its latest earnings profile, and a comprehensive view of both the bull and bear cases, so we can assess whether the current trajectory is sustainable. CoreWeave delivers GPU-accelerated infrastructure for training and deploying large-scale AI models, serving leading AI labs, innovative startups, and Fortune 500 enterprises. Founded in 2017, the company has rapidly expanded its data center footprint across the US and Europe, evolving from a niche GPU provider into a full AI hyperscaler. The March 2025 Nasdaq listing was a pivotal milestone, bringing public market capital to fuel further expansion. What differentiates CoreWeave is its laser focus on AI workloads and performance, rather than being a general-purpose cloud. That specialization has helped it win demanding customers that need large clusters of GPUs, high-speed networking, and low-latency infrastructure at scale. Revenue is anchored in long-term, multi-year contracts that create predictable cash flows and strong visibility through a sizable contracted backlog. Customers pay on a usage-based basis, so spending scales with their own demand while helping CoreWeave maximize utilization of its GPU-rich infrastructure. At the same time, this is a capital-intensive model. The company invests heavily in GPUs, power infrastructure, and data centers. That drives strong adjusted margins once capacity is online, but keeps reported net income negative during this high-growth phase. The key question is whether the combination of long-term contracts and specialized infrastructure can ultimately generate durable free cash flow once the current build-out moderates. CoreWeave delivered more than 2x year-over-year revenue growth, with quarterly revenue now in the low billion-dollar range, underscoring its emerging leadership in AI infrastructure. At the same time, the company reported a net loss in the hundreds of millions of dollars, driven by depreciation, interest expense, and ongoing expansion costs. The important takeaway is the dual narrative: hypergrowth at the top line, but investment-driven losses at the bottom line. This pattern is typical of infrastructure businesses in a scale-up phase, where management prioritizes securing capacity and customers over near-term profitability. On profitability and cash flow, the picture is nuanced. On the positive side, CoreWeave reports strong unit economics, with positive adjusted EBITDA and attractive percentage margins, along with robust adjusted operating income that signals pricing power. These metrics suggest that, on a per-unit basis, the model works. However, the company is firmly in an investment phase. Free cash flow is deeply negative, and capital expenditures run into the tens of billions annually as CoreWeave builds what it calls AI factories for future capacity. The investment case assumes that today's heavy spending on infrastructure will translate into long-term cash generation once the expansion curve flattens. The company has more than $30 billion of contracted backlog as of mid-2025, giving multi-year visibility into future revenue from committed customers. Demand is effectively capacity constrained. Across regions, AI training and inference workloads from major technology clients are absorbing new capacity as soon as it comes online. This rapid absorption reflects the intensity of AI infrastructure needs today. The combination of large backlog, capacity constraints, and continued workload growth underpins the bullish view that CoreWeave can sustain elevated growth rates for several years, provided it can keep delivering new capacity on schedule. CoreWeave is not standing still at the pure infrastructure layer. Strategically, the company is evolving toward a more full-stack AI platform. It has pursued acquisitions of software and tooling companies to enhance the developer experience and deepen its value proposition for customers. At the same time, CoreWeave is pushing toward vertical integration by pursuing ownership of power and data center real estate to control critical infrastructure more tightly. A key goal is reducing dependence on third-party data center developers by acquiring or controlling assets directly, thereby mitigating construction and delivery risks that have already impacted the company. These moves could improve reliability and economics over time. Despite strong growth, CoreWeave faces serious performance concerns. Execution risk is front and center. Third-party data center delays have already postponed capacity delivery for major customers, contributing to guidance misses and stock volatility. These issues highlight how dependent the company is on outside partners for timely construction and power availability. Leverage is another concern. CoreWeave's substantial debt load, taken on to fund rapid expansion, increases refinancing and interest rate exposure if capital markets tighten. Any slowdown in AI demand could amplify these risks, challenging the company's ability to service debt and maintain its aggressive expansion path. Customer concentration is significant. A large share of revenue comes from a handful of major AI and cloud buyers, creating dependency risk if even one large customer changes course. Operational complexity is another factor. Scaling multiple GPU clusters and sites at once raises the likelihood of outages, bottlenecks, or integration challenges. Financial fragility emerges from billions in obligations with near-term maturities, increasing sensitivity to credit conditions. Finally, the AI infrastructure cycle itself may be cyclical. Aggressive spending and leverage could signal broader AI bubble dynamics if end demand fails to keep pace. The bull case emphasizes hypergrowth, with revenue more than doubling year over year, a contracted backlog above $30 billion, and strong adjusted margins that validate the core unit economics. CoreWeave plays a central role supplying compute to top-tier AI customers and is strategically positioned in a critical infrastructure bottleneck. The bear case focuses on persistent net losses driven by depreciation and interest, massive capex and negative free cash flow, and execution issues around data center build-outs. It also highlights customer concentration, potential pricing pressure, sensitivity to AI demand cycles, and regulatory uncertainty around energy use and AI. Together, these elements show both the promise and peril of investing in CoreWeave today.